It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're focusing on what companies investors are currently betting big on with predicted long runways for growth and where there is not. I'm here with Chris Versace, Tematica Research Chief Investment Officer. And first of all, welcome to you. Thanks for being here.
Happy to be here.
See, I'm blaming the time change on everything everything that goes wrong today. Let's talk about your goodbye stock, and that is Marvell Technology. Now, the stock did have a pullback last week after its earnings, but let's get to why you like it here. AI and data center demand. First reason.
Well, let's start off by saying that there's a lot of different chip stocks out there. We tend to think about Intel, we tend to think about Qualcomm, but Marvell's a little different because its chips really go into the infrastructure that supports all the connectivity that we have. So when we think about the rampant spending on AI, or we hear from Google, Meta, Amazon, how they're spending on data centers, all that requires chips. And we know this from NVIDIA, who had stellar guidance. But guess what? Marvell did report last week, and their data center business was up huge. Like Donald Trump, huge type numbers, okay? There were some other businesses that didn't perform as well, but I think that as a result of the continued AI wave and what we're going to see as embedded AI comes to devices, smartphones, PCs, and really turbocharges the amount of data that we're consuming and creating, you're gonna see a rebound in the network and carrier spending, and that's really the second point.
In the places that had lagged.
Correct.
In that earnings report last week.
Correct.
Okay, so talk me through that.
So if we think about how our data gets moved around, it's not simply there it is, right? It has to traverse through a network, whether it's the wireless network, the fiber networks that we have, and there's all sorts of enterprise-related networking as well. So as this virtuous circle of data just explodes, not just because of ongoing 5G adoption, not just because of other applications that are coming, but really in the near term, this explosion due to AI, network spending is going to have to catch up. In the near term, what are we going to see? Network capacity levels will continue to rise as companies like AT&T, Comcast, Verizon try to hold off spending. But at some point, there's going to be a breakthrough wave where they have to upgrade their networks, because you and I are not going to be happy with subpar service.
Right, and that's interesting because it's not only predicated on the AI story, but on a bigger data story. And then finally, the stock had a monster run going into the earnings and then saw that pullback.
Yes, so like a lot of names that touch the AI space, the stocks had a significant run, not just so far in 2024, but really since the end of October. Priced to perfection, right? So not only do they have to deliver a great quarter, the guidance had to be stellar across the board. And as we saw, Marvell did disappoint, but that's actually opportunity for folks that have missed out. So we're seeing that kind of pullback now. They did one of the earnings playbook moves, I would say, which is we've seen companies that have delivered softer than expected outlooks either hike a dividend if they could or announce a big buyback. They announced a $3 billion buyback, and I think they're going to use that to support the stock.
Oh, interesting. Okay, so we always talk about the risk potentially here, and you've got two: time and market risk. What do you mean by that?
Well, time means that we just might be a little early, right? I think ultimately this is going to happen. The timing that I'm thinking about is we start to see the first wave of these new AI-enabled devices happen in the second half of the year, ahead of the holiday shopping season, fostering this big upgrade cycle. I say this because, well, take a look at what we saw at CES 24, Mobile World Congress, and let's think about what Dell announced just 1-2 weeks ago about AI-enabled laptops coming to market. It's going to happen. And then market risk is just the market. If we do see the market pull back in a meaningful way, Marvell is going to come down.
Right, and we've seen that with tech stocks specifically. Do you hold Marvell, by the way?
Marvell is one of the largest holdings in the AAP portfolio that I manage for the Street.
All right, good to know. And then if people are spending money on mobile phones and networking and things, something maybe they're not spending as much on is in a department store like Dillards, which is the stock that you're saying to avoid. Macy's, which we were talking about earlier. The stock's actually had a little bit of a rebound here. So Why do you think that Dillards is not going to benefit?
Well, a couple of reasons. One, if you take a look at a lot of the data that we see, and I'm sure others see as well, the consumer still remains very selective. They're not just willy-nilly spending. And I think that if we take a look at the consumer debt levels, because we just got the January Consumer Credit Report, wow, they really took on a lot more debt. So they're going to be even more selective going forward. So I just don't see folks flocking to department stores anymore. And the data shows that, right? So when we look at the next data point, in the last quarter, the holiday shopping season, department store retail sales over the trailing 3 months fell 4.7%. People are not going there. Worse, when Dillards reported its quarter, they were down 5%. So they're losing share.
Right, and they're losing share too. Let's get to the next one here. Amazon and other sort of online retailers.
100%. If there was a stat that I saw that Amazon is 34.5% of all U.S. online retail sales. And if you go outside of online retail sales, they're around 16% of total total apparel sales. That's going to hit the department stores, square in the gut. And then there's Costco, which, believe it or not, and this number is just a little old, they're about $9-10 billion in apparel. So the competitive forces are circling.
Interesting, and more value probably compared with the Dillards. What would be the risk, though, to the upside here? Is that the economy ends up better than expected?
It's simply that the consumer is way stronger than we expect. Job growth surprised to the upside last week. Wage growth still a little bit better for job changers if you look at the ADP data. So to the extent that real wage growth accelerates, well, people have more money, they'd be able to spend more.
Right.
I still don't think they're going to do it at Dillards.
Fair enough. And do you have any position in Dillards, by the way? Okay, so let's summarize your case here, and it really has to do with where people are spending their money. You're saying buy Marvell due to the company's strong financials and the growing demand for AI, but just for networking more broadly. On the other side, you say avoid Dillards due to growing competition in the retail space and a more choiceful consumer. I believe that's how Walmart executives have put it.